Hey everyone, I'm 𝗦𝗃𝗃𝗀𝗃 at Setter Capital, where I work as a broker advising clients on VC direct secondary transactions, and welcome back to Secondaries Simplified. Today we're breaking down one of the most frequently debated questions in private markets for VC, namely what actually drives pricing for VC secondary transactions. Unlike public markets, where information is readily available and pricing is continuous, in private markets, pricing tends to be opaque and is a function of investor psychology, company fundamentals, sentiment, market context, and structural considerations that can materially shift where bids and asks ultimately converge. Moreover, spreads also tend to be much wider, and as a result, assets are typically less liquid. With that, let's walk through some of the primary determinants of pricing. Firstly, and certainly the most significant factor, is last round valuation and its recency. A recent primary round, say something within the past 6 to 12 months, remains the strongest reference point for secondary pricing, and for the most part, buyers and sellers speak in terms of discount and/or premium relative to the last funding round. However, as a round gets older, its relevance tends to decay. And this is because stale data typically results in discounts unless there's clear evidence of outperformance or significant operational de-risking since the round. Conversely, meaningful company-level progress may warrant a premium. We also have the round quality and the quality of investors who participated in the round, as pricing is heavily influenced by who led and participated last round and whether it was an up round, flat, insider-led, bridge, safe, etc. A high-quality syndicate validates valuation, while an insider-led extension or down-round dynamics generally depress pricing. Thirdly, company fundamentals and forward trajectory also play a meaningful role. This is because sophisticated buyers diligence revenue growth, margin structure, burn and runway, retention, unit economics, the path to profitability and exit. And so weakening metrics, such as rising churn or increased cash burn, are incorporated quickly into pricing models and often result in immediate repricing and some discount, whereas strengthening fundamentals often tighten spreads and might warrant par or a premium. Share class differentiation. Share class rights can create meaningful divergence in value. Preferred shares with liquidation preference, anti-dilution, protective provisions, or information rights often command better pricing than common shares or junior securities. Two holders of the same company may have equal proportionate ownership, but the economics rarely match depending on the class of security. This also leads into the fifth point I want to address, which has to do with the capital stack and its complexity. For example, multiple preference layers or heavy liquidation overhangs materially impact valuation. Buyers price not just the business, but also where their shares sit in the company's waterfall, which often explains wide bid-ask spreads in structurally complex cap tables. For example, some of these decacorns or private companies that have valuations in the hundreds of billions of dollars might have shares ranging from Series Seed to E, F, and G. And so the later preferred shares can have significant rights or liquidation preference over earlier pref shares. Expected future financing is also an important factor. If a company is positioned for a strong up round, buyers may stretch. If a down round is anticipated, runway is tightening, or a company is signaling capital constraints, pricing tends to reset quickly and discounts widen. There's also a question around deal structure, which is to say direct versus SPV or forward contracts or some other unique structure. Direct transfers are cleaner and generally support pricing due to lower friction and reduced structural risk. SPVs, or special purpose vehicles, which we discussed in our last episode, introduce additional economics such as carry, administrative fees, governance considerations, and buyers may discount for this. However, some buyers prefer SPVs for targeted exposure or access advantages. And in marquee names where direct access is reserved for highly sophisticated and/or a short list of already approved buyers, SPVs might be the only available avenue for most market participants, and so price in the same way that direct trades typically would. Lastly, we have execution risk, transferability, and company process. For example, consent rights, right of first refusal, slow or opaque company processes, and general execution risk can also drive discounts. Buyers tend to price certainty and a lack thereof accordingly. At 𝗦𝗏r, we work with both buyers and sellers across these dynamics. Depending on the mandate, we can broaden the buyer universe, run a structured process, or help allocators source exposure to specific names or themes they care about. If you're active in secondaries, we're always happy to connect. This episode is for informational purposes only and does not constitute investment, legal, or tax advice. Sellers and buyers should consult counsel to understand their rights, transfer mechanics, and any company-specific constraints that may impact pricing or timing. As always, thanks for joining Secondary Simplified. I'm Ezra at 𝗦𝗏𝗃 Capital, and we look forward to seeing you on the next episode.